Hey guys, it's an exciting time in the uranium complex as it looks like we may be attempting our breakout a bit sooner than expected. This is going to cover Energy Fuels Incorporated, which is UUUU, or the four U's, as well as the URNM and the URA ETFs, the descriptions for which will be posted below. And well, sure enough, we have a rally in place. We were looking at more downside ahead. That's what this red 2 is indicating. But we're actually starting to break through. We're having a lot of signs that we may have started our rally up. It's not as apparent in the 4Us, but when you look at the two ETFs, we are clearly getting into the zone where we need to go. And that zone is what we call the pivot zone. So I'm going to shift back to URNM. This is the Northshore Global Uranium ETF. And what the pivot is in Elliott wave theory is it's really the maximum extent you can go without for a fifth wave to hit. So if this entire thing is an incomplete structure, either a fifth wave or a B wave would not get through the 0.764, and well, it would not be able to hold support here. So once we break through that 764, and if we can maintain the bottom, so if we break through 93 and stay above 89 the rest of the way, that is what we call a confirmation. That is a very, very strong sign that we have a rally ensuing, presumably the third wave of probably a larger third wave. So that is the excitement here. We're not quite there yet, but we're getting very close. And my own personal strategy is that I'm going to probably buy longs once we get right at that pivot, the top of that pivot box, and that would apply for URA as well. And the 4Us, I'm not sure exactly which options I'm going to buy yet, but I'm going to go over some of the available options, no pun intended, later on in this video. Now, a quick, to make this safer is that you wait for the pivot to break through. So once you get that pivot, that's a good sign. You would set your stop ideally at the bottom of the box. So for the 4Us, for example, it'd be at 1094. That way you get stopped out before we have any more downside, because at the end of the day, remember, we didn't go low enough in any of these securities to complete a more legitimate looking second wave. So there could be a lot of downside ahead if we don't manage to hold our upside setup. But the way commodities are going all around, I am relatively optimistic, which is the whole reason I've started getting the hype machine going on uranium again. So I'm going to go to the big picture, and we're going to use the 4Us as our main benchmark, our main indicator of sentiment here, just because it's been following the fibs pretty well. And obviously I've got quite a following for this particular security, but we have a large rally after what was very likely a multi-decade low back in March of 2020. That was the everything crash, where literally everything crashed except for probably bonds, but even those crashed after that. But we have our clear 5-wave rally. It hit perfect proportions. All the fibs were hit. Even the subdivisions, substructures, everything was perfect. So we're calling this entire thing a large 5-wave rally. That is wave 1. And of course, I'm going to clean up my nomenclature. It's been mixed up and jumbled at the moment. But our primary pattern was that this was actually a B-wave bounce, and that we have a pretty deep C wave to come, because we didn't quite go low enough for this to be a more of a textbook second wave. We only hit the 23.6% retrace. So we're not out of the woods yet in any of these securities. The same applies to the ETFs. We have that as an alternate pattern where this is a B wave bounce followed by a deeper C wave. So again, this is why using stops are important. Got to use your risk management appropriately. The later you wait, you may have lesser returns, but you also reduce the likelihood of getting caught in an ugly pullback. Now, what's exciting is that since we are finishing a second wave, we are expecting to hit a much larger degree third wave. So if that's the 1, that's the 2. This could be a multi-year third wave. Even though we're playing what is probably a subwave 1 of that larger third wave. So it may take quite a while to materialize. It just shows you this might be a very lucrative play for several years going down the line. Again, we've hit a multi-decade low, so it's going to be pretty spectacular to think where we could go further into the future. Now, the other thing I want to point out here is that I have these timing bar thingies here, and just to give us a better idea of what the timing might be for this play, I actually looked at the previous third wave. So this is the third wave of the larger degree first wave, and from basically, if we consider this to be a 1-2 nested setup, that's about where I start the clock, basically. And if I do that, it shows us that the entire third wave from that point, the top of the third wave, that took about 119 days. And if you only want to count this peak, which is the third of the larger third wave, that took about 41 days. So I took those and copied and pasted those over here, assuming we have already got our nested 1-2-1-2 setup in place as I was displaying here in our short-term picture. So setting our clock approximately there, that would put our third of the third at about May 19th, May 20th. So that would probably be about, for at least the 4Us, hitting about $15, $15 to $17 in that range, and getting the upper targets anywhere from $19 to $22 for the actual larger third wave. That is pointing at about August 5th. And the reason I use this as an approximation is it's actually relatively conservative, because you have to remember the third wave we are playing here is on a much smaller degree than this third wave here. This is actually on a larger degree. So I would expect these to be, well, about as long as it would take, especially considering that this is presumably a third wave. Things could move very quickly, and third waves do move fast, because you can see here from our second wave bottom, we went parabolic for the third of the third, and then we had some chop, and it was still moving pretty fast even for the larger degree third. But you can see how as you get more 4-5s in place, things slow down. So this is why it is important to be careful when you start messing with fourth waves. You can get ground apart by how slow and sideways they move. So that's what we're looking at here. Now we're going to go to the actual targets. So I already gave some hints here for the 4Us. We're expecting this third wave to hit somewhere between $19 and $22. That would be the 1.32 to 1.61 extension of this larger 1-2. That's what you see with this fib here. This box has some confluences. It may not play much of a part on this chart anymore, but that's what we're targeting. It might be a good idea if we play the third of the third, and then you could take some profit off the table and roll that forward. As for the options, out of these securities, the 4Us has the most choice, the most options, and there's a lot of liquidity in July. So July 2015 expiration, and you have strikes at $12, $14, and $15. And my rule of thumb is usually I'm looking for open interest that is north of 1,000. So the more you have, the better. Just a general rule of thumb, if I see something with 3,500 open interest versus something with 1,200, 3,500 is probably going to take the cake there. Now, as for timing, I did mention the 27 days and the other one, the 118 days, whatever, August. If I'm playing something longer term, it would be preferable to get something further out in expiration. However, as I mentioned, if you're playing the third of the third, it may be safe to buy a July call. And then once we get in that range, again, between about 14.91 to 17.35, you can probably take a bunch of the chips off the table, you can roll it forward. Maybe there'll be more liquidity by then in further out months. As for further out months, there's very little, there's actually nothing for August. There are some calls for October that have really poor liquidity. And the next best thing would be to go with January 2023. There are $10, $12, $15, and $20 strike calls. That might actually be the smartest way to play this because it's very conservative. And honestly, the prices are not too bad. So moving on from UUUU, we're going to go to URNM. So this is, again, Northshore Global Uranium. And I have the same setup here. You got the 1-2 in blue. And this would mean that our third wave is targeting somewhere between 123 and 134, 135, right in that range. The third of the third could hit somewhere between 106 and 116. And I'm not going to put the timing on here again. I'm just going to assume that they're all following similar timing, which they've been over the past couple of years. And if you are playing this, we're going to have a rally again from 93, where we are right now. Well, 91 more or less, to about 122 to about 134. The options, the only thing I'm seeing is December 16th of 2022. There are strikes for 100 and 140. There's really lousy liquidity everywhere else. So that could easily change. You can keep your eyes on it. But if you really want to play options and leverage in URNM, you're going to be best off going with December calls in that range. And you can't really go wrong with that. 100 is pretty close to the money, and 140 is actually not too far out of the money considering where our targets are overhead. And finally, you have URA, which is our global X Uranium ETF. Again, our 1-2s in blue. And we have our Fibonacci extension tool built out here. Our targets for the third wave are between $37 and $40, around that range. So we have a few more options, a few more choices for options within this security. You have, if you want to play really high risk, we have May 20th, 28 strike calls. I don't think I would want to play that. That sounds really risky, although it is very close to the money. So there may be some, it might make sense for some of you, aggressive traders, shorter term. There's a lot of liquidity in June of 2018. So if you're trying to play very short term here, June 18th of 2022 would not be a bad choice. Again, lots of liquidity. That might be one I consider playing. If you want to be a bit more conservative, there are strikes in July of 2015, plenty of calls. 29 and 30 were the ones that stuck out to me in particular. And finally, if you want to do this right and be more conservative, more safe, there are October 21st strike calls for $40. And those are sitting around $160 right now a piece. So those sound pretty good, especially considering where our targets lie. That might go on the money just on this third wave alone. So that's a good sign. The other thing I'd like to point out is that we are only playing the third wave, as I mentioned. 4-5s can chop you up. They grind sideways for a long time. They cause a lot of theta decay. You can't always tell when we're going to actually take off in the fifth wave. Fifth waves are slower. They take a while to get going. So it is, in my personal opinion, and from my own experience, it's best to just play the third wave and get out, take profit, because there's going to be plenty of upside ahead, especially if you buy later. You might be able to get 2-3 months of theta decay and then buy the options to play that fifth wave later. And as for the ultimate big picture fifth wave, that's where things get exciting. If you are a very long-term investor or trader, and especially if you're playing non-leveraged, you could start accumulating these positions. If you've already accumulated from the past, good on you. You're up big, especially if you bought in 2020 or 2021. We haven't had really anything meaningful pullback wise since we hit that bottom in early February. So if you're holding, it may be prudent it may be advantageous to hold longer term. And if you're into leaps or really long-term options, I can't really fault you for starting to accumulate positions. That might be the smartest way to play this overall. So I'm going to have a lot more detail on what I'm actually doing. I'll have alerts out and the specific call options that I'm playing, as well as stop out points. And we'll be moving up our support as this rally materializes. However, if we break support and we start pulling back, we got to accept what the market does, because the market does whatever the market wants. Once the data changes, you got to change your mind. So don't miss out. Subscribe. And if you enjoyed my video, don't forget to give me a like. Till next time, thank you for watching.